Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Venture Global. Get their investor presentation back up so you can see that. And Venture Global LNG, I'm going to go through just a couple details out of their investor presentation here. There's not a whole lot of news in their actual Q4 results because, they had a whole lot of details in their S1, which was, very recently filed. But I'm going to go through just a couple tidbits here and then go through an updated valuation model that I have for the company. Since I previously had one, it's changed a fair bit after some of the details that were now released with these earnings. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I do not currently hold any Venture Global stock, but I may in the near future, given where the price is at. So this video should be for your entertainment purposes only, because I could be wrong about everything that I say in this video. You need to do your own research before making any investment decisions. All right, so Venture Global LNG, they just came out with their inaugural earnings report, and they finally released a couple numbers. And so, of course, I guess I could go over here. The market hated it. You can see the massive drop. If you haven't been following the stock, you can see it was trading around, in the teens, the mid-teens here, about $14. After having just continued to drop after the IPO, and then when the earnings came out, it dropped down to about $10. Pretty quickly. And I can go to the heart of what I think really the issue is here, if that's really all you're here for. To my knowledge, they never firmly disclosed what their pricing was under their long-term SPAs. And when they released these earnings, they finally did that. And I'll zoom in here because it might be a little small for you to see. But they have, some of their numbers here from Calcasieu Pass. And they say, oh, here's our production summary and our forecast, for 2025. It's really just this number right down here is what made the biggest difference in my model. And I can go through, I'm going to talk through this in terms of why I think this had such an impact. But, they say, hey, our long-term SPAs are priced at about 197 per MMBTU, which is abysmally low, right? I think in my original model that I did in my prior video, which came out to about, somewhere around a $15 intrinsic value for the company, $15 per share. That was assuming that they had in the high twos or maybe $3 per MMBTU. And again, sorry, if you're unfamiliar, this is basically the fixed fee on top of the liquefaction contracts that they have. So they usually price them with, the cost of the feed gas is priced at Henry Hub plus a percentage of that amount to handle the transportation, the actual pipeline to get it to the LNG export facility. Then they have this fixed fee, which basically represents what margin, what profits does, not profits, but what revenue, I should say, will the liquefier, in this case Venture Global, get for liquefying that gas into LNG. And, traditionally you'd expect to see numbers for these. I think next decade, if I can recall, I believe they have about a 250 average on that, which still isn't particularly high, but is, in the, I think that the mid-range that you'd expect. Venture Global, for theirs to be priced, ever so slightly under $2 per MMBTU was a bit of a shock to me. And I'd actually heard this, right, somewhere around the IPO. Hi, Transient Sacker. Thanks for hopping on the stream. Somewhere around the IPO, someone on Twitter who's big in the LNG space, I don't recall exactly who it was, had said, hey, I heard some clip of the Venture Global CEO saying our contracts are priced at around $2 per MMBTU. And I was a little skeptical of that, to be honest, but here it is right in front of me. And I think I posted right then on Twitter that I was like, hey, well, if that's the case, the intrinsic value for the company goes to more like $7 to $8 per share rather than, what I originally thought of like $15. And this makes a big difference as you look out into the future. And I'll go to my valuation model in a minute. But, they sign these they're locking up a lot of their capacity, right? Even with Venture Global, when they say, hey, we think we can produce excess capacity over and above our nameplate and we can, contract that out on better terms or sell it at spot. The vast majority of their capacity is contracted under these long-term agreements. And so when the pricing on those is so low, the incremental cash flow that they get is sort of really, it's just not that profitable. The other number that came out of this, it has a smaller impact, but my original estimate that I'd gotten for what is their cost of, operations and maintenance at their plants was pulled from what Cheniere is able to do. And when I looked at their costs based on their actual I think it was their, I think it took an average of their entire 2024 results. I just looked at how much LNG did they produce, and then what were the operating maintenance costs for those, and divided out to get sort of an average number per, per cargo. And when I looked at that, they were actually worse on their expenses were higher per cargo than what Cheniere is able to do. Right, it was somewhere along the lines of 10 to 15% higher, and so again, that just sort of incrementally ratchets that up, that where they're not quite as profitable as what I was modeling them as. And when their liquefaction fees are so low, that sort of squeezes it more when you look out further and further in the future. So let me get to the valuation model, because I think that's what, I could talk real quick just to sort of mention the, how much of an impact this has. Let me go to their actual full 2025 guidance. Let me fix the height here so we can go down. And I just want to break this down real quick, right? Because you might look at that and say, yeah, but they're guiding for, 6.8 to 7.4 billion in adjusted EBITDA next year. So here's the thing with that, is that $6.8 billion, let's call it, I'm just going to use the low end of the range here. And again, I think that's sort of scales based on how much they're actually able to produce. I ran through all the numbers here, and that breaks down to, of that 6.8 billion on the low end of their production range, about $5.5 billion of that EBITDA, if I could reverse engineer all their numbers and get this correctly, $5.5 billion comes from the commissioning cargoes at the Plaquemines. $0.9 billion comes from the Calcasieu Pass commissioning cargoes that they're going to have up until, a month from now on April 15th, when they finally declare that as in sort of commercial operations. And then all of that capacity will be being contracted under the long-term SPA pricing, right? Which drops from, and again, if we go back and look at this, drops from, for Calcasieu Pass, $8.97 per MMBTU down to $1.97 per MMBTU, right? So that's like a 70% drop in profit per cargo. And then when the addition, so that's 5.5 from Plaquemines commissioning cargoes, 0.9 billion from Calcasieu Pass commissioning cargoes, and then $0.2 billion in EBITDA from the long-term SPAs, right? The LNG that will be produced at Calcasieu Pass that is sold under their long-term sales and purchase agreements, right? That's already contracted. That's the $0.2 billion in EBITDA, right? So of that 6.8 billion, only 0.2 billion is going to come from one of their two facilities that they're going to have, the one that's not even ramping up, the one that's at full nameplate capacity for the remainder of the year from April 15th onwards. And so that's tells you how much less profitable this is really at $2. I'm rounding up to $2 per MMBTU. And, those are the numbers that I got. And I know that doesn't add up exactly to 6.8 billion. I think that's because of a couple rounding things that I had to do, or maybe, on their side. But that I think it adds up to, 6.7. And so that's how I did quite a bit of math to get to that point. I'm not going to reverse engineer all here. If you really care, you can ask me on Twitter, on the comments. I'll give you all the details of how I got to that point. But suffice it to say, the vast majority of the profit is coming from these commissioning cargoes. And that has a major advantage for them, right? Where they're able to actually recoup some of their investment earlier on. And in fact, they're not using that to pay down the debt. What they're really doing for this is to forward this on to the next project, right? That's their stated plan. It was in their S1 where they even said, hey, we believe these commissioning cargoes that we can sell at massive profits relative to what we sign on our SPAs gives us, cash back pretty quickly that we can then recycle into the next project in order for us to then, own more of the equity without having to do so much dilution. And that is good. But on the flip side, I'm coming back to, if they're signing these SPAs at very, very low rates, the long-term profitability of those projects is just not as high as you'd expect, historically. So anyways, I will go to the actual valuation model now. I just want to kind of talk through a little bit of that, because these are the biggest numbers that I pull out of this, right? Is what do they actually deliver? What do they have contracted? What was their pricing? Because that was a major question that was never answered in the S1. And then just picking apart their guidance for 2025, I just wanted to sort of go over that a little bit. Now, what I did here for a valuation model for the company, this is updated, and it's both more detailed than the prior model that I had, and I used the numbers that they actually have from their long-term SPAs and some other numbers that they're using from their short-term pricing and such. I'm not going to go through every single bit here because there's a lot. I'm going to try to go through it without slowing down too much. So I modeled each individual facility out by itself. So I have the Calcasieu Pass here, and I have this one starting commercial operations in 2025 and extending out from 2026 onwards. I did include about 25% incremental excess production from this facility, or maybe 20%, 25%, somewhere in that vicinity, because I think this one was not quite as high as the others. And I assume that excess production capacity is still sold under that sort of fatter margins that they have. It's closer to that, $7 or $8 per MMBTU. In fact, here I actually use $7 per MMBTU for all the years after 2025. But I have this facility here, and that's how that's modeled. And then I add this up just to get their net revenue. And then I also subtract off my estimate from their operating maintenance expense. And again, this actually came from a sort of a normalized amount based off of what they were able to do in 2024, right? I looked at their actual results, how much did it actually cost them for operating maintenance expenses to produce the LNG that they did produce, and then carried that forward. And that's the way that I estimated the operating maintenance expense for all of these facilities they have. Now, I just carried forward the G&A expense. I assume that it stayed flat at $20 million, year over year. And that lets me calculate sort of an EBITDA number for each plant. And again, I'm not worrying about how these are financed quite yet. That I have a separate section for their actual CapEx and for their debt that they take on. But you can see here their EBITDA in 2025 for Calcasieu Pass is going to be much higher because they have some amount of commissioning production. But that goes to zero in 2026 and onward. And so that drops down. Their EBITDA is cut, into 1/3 of what it previously was in 2026 onwards, because they actually hit commercial operations. And then one other thing to note, and I think that if you read through their documents, you would have spotted this, that at commercial operations, 23% of the ownership, some preferred shares or convertible debt or something, gets converted, and some other party owns 23% of the facility. So I'm modeling this as if it's actually 7.7 million tons per year in terms of nameplate capacity, even though it's actually 10. And so that's how I'm just modeling it out here. I'll be a little faster. So I did the same thing, or similar model for the Plaquemines project. And, they're commissioning this all the way up until, I think, middle of 2027. And they switch over to commercial operations. And this actually goes, there's the, I believe there's 2 phases here. And so I sort of have it mixed there. But then eventually by 2028, they're just at full commercial operations, and they have the 20 million tons per year that they will be selling under the SPAs, and then incremental excess capacity of 7.2 million tons per year. And I think this is what they have most of their permits for this. Maybe they're missing their non-free trade agreements for that, or maybe they have them all for Plaquemines. I don't remember. It was a similar model where I assume the excess production can get sold at the excess production and the commissioning production can get sold at what I call the short-term pricing margin, but then the obvious, commercial operations and sort of long-term pricing margin. And they did not fully disclose this in their presentation, but I assume they continued signing contracts at $2 per MMBTU because apparently they're happy with that. And so that's what I included in my model. Now, again, if they actually had higher fees on some of the Plaquemines contracts on their sales and purchase agreements, then this model would be undervaluing the company, right? If they actually came out that this was, $2.50 per MMBTU for the Plaquemines contracts, even if Calcasieu Pass was at $2 per MMBTU, that's obvious upside that the stock would have. But they did not disclose this, so for now, for all of this, I'm assuming that they just are happy signing these at $2 per MMBTU for the fee. And there's actually a little bit, I quickly listened to the earnings call. I haven't actually got to comb back through that. So sorry if I missed some massive detail, and something I say here is, sort of wrong because they gave more details in the earnings call, and I just missed it because I've only listened through it once quickly. But one of the things that they did talk about on the earnings call was that they are happy to sign these contracts at kind of lower margins because, they believe they're profitable, and because of the model that they have where they can actually get this excess capacity and, basically overproduce on their nameplate capacity. And because, and they were very clear on this, that this is their strategic, it's strategically important for them because they say, hey, we can basically gobble up the demand in the market to where other companies, other export facilities that are looking to expand can't or won't compete on price, right? And again, like I said, I think if I recall correctly, the Next Decade, which is a clear competitor, I believe that Next Decade's contracts for their phase one, which is trains 1 through 3 of the Rio Grande facility, are priced at around $2.50 per MMBTU, right? And so if Next Decade is going out in the market and looking to sign contracts at, 250, 240, maybe 235, they say, hey, that's the, for whatever reason, maybe they go down a little bit off of that 250 range. But to go all the way down to $2, maybe they say that's just too low for us. Whereas clearly Venture Global has no problems doing that. And they state as much, right, that that's strategically important for them to gobble up that capacity. And so it is interesting. And this is also why I'm just explaining to you why in my model here, I'm modeling that out as only $2 per MMBTU because it seems to be their strategy. So anyways, this is how I sort of look at the Plaquemines project. And once again, if you go down here and you see the actual EBITDA that comes out of that Plaquemines project, it's much higher in 2025 and 2026 as they have these commissioning cargoes, but then it drops down starting in 2028 and 2029 where, they hit commercial operations. And because the majority of that capacity, once again, is being sold at $2 per MMBTU flat fee or margin, rather than sort of that higher margin that I modeled here as $7 per MMBTU. Now, they do have a larger percentage of that capacity that is, excess production, right? That 7.2 MTPA. And so they do actually get significantly more EBITDA out of the Plaquemines project than they get out of the Calcasieu Pass. Not only because it's a bigger facility, but also because they have a higher proportion of their overall production that is this excess production that is not under any long-term SPA. So that is the Plaquemines project. And so again, long-term, they're going to hit this point where they are about $3 billion per year in EBITDA from that facility under my model. Now we have the CP2 project, and I'm assuming that they get all the permits. I don't think that's going to be an issue with the current administration. And I modeled out, both a phase 1 and a phase 2 hitting FID roughly when the company, I think this is roughly when the company guided. I don't recall. I adjusted a couple of these just because, I was a little skeptical of certain things. You assume some delays when a company is projecting out FIDs. I think the phase 1 could come quickly, though, because I believe they have I think they have enough SPAs, enough volume already contract in order to support the financing for phase 1. Phase 2, I don't believe that they have that yet, but, if they're willing to sign contracts for a low price, I think that's good. I guess maybe as one other point that I should note here, they didn't state this outright, but I wonder if some of their strategy for signing these deals at a low price is also because I think some folks, if given the choice at equal pricing between Venture Global and a competitor, might choose the competitor because of some of the delays that Venture Global has had at the same time where they've been exporting their commissioning cargoes, right? And this is why they have those still ongoing lawsuits with a number of their counterparties that sign the SPAs for Calcasieu Pass. People looked at that and might prefer to do business with a different company if the price was the same. However, if Venture Global is offering, cheaper pricing on a commodity, that's a really hard decision for another company to really go with and say, hey, we're not going to go with the cheaper commodity pricing for, 20 years into the future locked in just because, just because some things that happened in the past that maybe were in their control, maybe weren't. I think people are going to be watching very closely what happens with the Plaquemines project and if they have these additional delays that happen that Venture Global states are out of their control, or not, right? And so I think if Venture Global is able to deliver the Plaquemines projects on time, they will to some degree kind of they will help out their reputation, maybe repair some of that damage that they did that happened with the Calcasieu Pass project. Anyways, getting to the CP2 project, I assume FIDs, phase 1 FIDs in, I said Q4 of this year, and phase 2 FIDs in Q4 of next year. And then you get LNG starting to be produced in, I don't know why I have some commissioning production here, even though I say first LNG here. Anyways, I think I was just moving some things around based on the timing, but I'm going to go with my numbers because that's what I spent more time on here, and I think that's credible, right? If the FID in 2025 to get some LNG in 2027, given the fact that I think they've even started purchasing the trains for this, if I recall. I think that was in their investor presentation. If you go back up here and look, and they said it was, yeah, they've already executed a purchase order for an additional 36 LNG trains for CP2, right? So 12 of those are already being fabricated, right? So they're not FID'd on this, but they've already ordered some of the trains. And so that's why I put some of the first LNG pretty early on for this one, earlier than what you'd expect, given that I'm saying, hey, maybe they'll FID this in Q4 of this year. Going on with this, though, you can see that they end up, they have some commissioning production, but then they end up starting in 2031 where everything's reached commercial operations and they have 20 million tons per year of nameplate capacity and nameplate production. And then they have, for this, I just assume 25% incremental excess capacity where they can make 5 more per year. And so that gets them 25 total. Again, 20 under the long-term SPAs and 5 under the short-term pricing. And that would get you to a total EBITDA from that facility of about $2.5 billion per year in 2031. And again, that would be down from the prior couple of years when they have all those more LNG being sold at the shorter term pricing because it's commissioning cargoes. Anyways, now we can add up all those facilities, subtract off some of the corporate expenses. And again, these I just basically pulled from their most recent year and or the most recent quarter and kind of annualized it. And kept it flat for the entire period that I modeled out here. And so you subtract off the corporate expenses, add up the EBITDA that they get from all of those facilities, and that gets you to your total EBITDA for the company. Then you have to look at their debt, and I modeled out both their current debt that they had at the end of 2024, which is just, it's about $29 billion. But then I also added on the new debt that they would accumulate because I'm assuming that they FID some of these facilities, right? That FID CP2 phase 1 this year, CP2 phase 2 next year. Really, those are the only two that are modeled out. And I have a second scenario here when I'm go through after I get through this that says what does it mean or what does it look like if they do a couple more expansions. But then you can get their total debt. I assume a weighted average interest rate on their debt of 7.5%, which gets down to their interest expense here, and that grows over time up to about $3.1 billion per year. I also modeled out their CapEx. I assumed a 60-40 split of 60% debt, 40% equity for all of these facilities, and kind of use those numbers out here and use some of their past some of the past amounts that they've spent on these facilities just to model this out. You can take a look at it here and what I'm assuming. Again, $6 billion in capex for CP2 phase 1 and $2.4 billion for CP2 phase 2. You can get their total capex per year, and then I can calculate the free cash flow, right? So I also put some estimated, how much they are going to depreciate, just so that I can estimate their tax expenses, and then given their EBITDA, I add up that from the facilities, subtract off their interest, subtract off their estimated taxes, subtract off their capex, and then we get our numbers for our free cash flows, right? And now this comes along, and you can see sort of they have a couple years where things go all over the place as they're investing some in order to build more of the facilities, and then eventually they kind of stop investing and they have a couple really good years because they have commissioning cargoes without the reinvestment, and then they sort of level off and they have this sort of long-term every year free cash flow they just kick off of $2.5 billion, given all those assumptions, right? Given their two facilities they already have FID'd, and then the CP2, both phase 1 and phase 2 being done, gets you to that point. Now, I also model out the cash every year just to make sure they didn't go negative, which they don't under this model. And then I come all the way down here to, I can look at their cash flows every year, discount that back to today, use a 10% discount rate, and what is the net present value of all those cash flows? And that's, your discounted cash flow model here gets you to about a $21.2 billion valuation for the company at present. They have about 2.7 billion shares outstanding. And so that gets you to a current intrinsic value per share, again, assuming all of the assumptions that I put in this model, which is a lot, of about $7.85. So, my super rough estimate before, when I said, hey, at $2 per MMBTU, for their long-term pricing, intrinsic value, as I calculate, is probably somewhere around $7 to $8 per share, I think is what I said on Twitter, is fairly, it sort of fits with this model here. And so I think, again, this is how I view things. Sorry, I see we comment. Ree says, hi, Ree. Hot sauce, I was hoping for Cheniere 2.0 will never be replicated. Yeah. They're just signing these contracts at such a low profit margin, right? They just for fun, let me go up and update the numbers. Let's assume if instead of 197, if this was just 250 for all of those long-term SPAs, right? What does that do to this share price? Because it makes a huge difference, right? It sounds like it's only a small difference, a 25% difference, but that's their revenue on the vast majority of what they're bringing in. Their expenses don't change, right? Whether they sign $2 or $5, what it costs them to, operate those plants doesn't change. But so, as you add on 25% more revenue, that goes straight to the bottom line. And so if I do that, I'm ignoring all the rest of this and just scrolling down here, that brings you, I guess it doesn't make that big a difference of that 25% increment, but I mean, that gets you, what's that, a 30% higher stock price, 30% higher intrinsic value per share. And I think, they could be even higher, right? I think, there were times when you could have signed contracts in the high twos, maybe even around $3 range. But even just doing that, which I think is on par with other companies, gets you 30% higher. But yes, this is not necessarily the next Cheniere, at least not immediately, right? They do have a lot of potential. I will say that, because, there's some knock-on effects here. If they really can grow fairly quickly and push down pricing for the overall market by being more profitable, signing lower price contracts, that is pretty interesting. And you have to think through what are the full implications on the overall market, right? And really what portion, how much of the market can they really do this with, right? Because if you're only a small fraction of the market, somebody gets a good deal to sign with you, but then, all the rest of the demand for LNG has to find someone else to sign with because they can only supply so much. But I mean, Venture Global has more facilities, right? And so that's one thing I gave this disclaimer, my first valuation model. I should give it here as well. I am giving no credit in this valuation model, right, for their additional facilities, for their expansion potential. So, I mean, this is kind of like a floor valuation, and this is not giving value to those other facilities that they, have some, potential to develop in the future, where they have some, I think they have the land, the leases, they just don't have, nothing started on those. It's just an idea, but, they have the potential, they have the expertise to do this. And, if they were giving the cash flows, I mean, even in this model, you look at it and you say, hey, well, where's my free cash flow? Somewhere around 2028, they basically stop reinvesting, and they could reinvest quite a bit of money. That's, $3.2 billion, $5 billion. That's a lot that you can put into equity for the next facility and the next facility and the next facility. And they do have quite a long runway of growth, right? So I think this is I should qualify what this number is here, right? This is the intrinsic value per share, just from a fraction of what they are capable of doing, but sort of what we see line of sight to them actually doing over the next 5 years. Let me put it that way. They could continue expanding further and further past this. Then again, you can make that, argument about other companies, right? Because of course a company is going to say, well, yeah, we can expand out of this and that and that and the other thing. But it's pretty far out in the future, right? I think by the time they would have these cash flows starting in 2028, you build a facility in 2028, produces first LNG in 2030 or even 2031, and doesn't hit commercial operations until 2033, let's say. You're talking something where your first any incremental EBITDA that you're going to generate from that, any incremental revenue, is at least 5 years away, maybe even further. And if you want to invest for the long term, and you say, I believe in the company and I think they're going to continue on with this cycle of reinvestment and growth, yeah, there's definitely the potential for this company to grow much larger, right? So I don't want to say that this won't be a Cheniere 2.0. This company has humongous potential in the future. The thing that I don't like as an investor, as a potential investor, is just that it seems like they're willing to accept really low margins for the time being and for quite a while. So that's sort of counterbalances out the massive volume that they could produce quite a bit, in my opinion. So I guess the takeaway from that massive monologue of qualifying this number is just that there's definite upside to this, right? This is what I would see as a floor price, where if I can buy the company for this, if you believe they're going to at least get through, CP1 and CP2, or CP2 phase 1 and phase 2, and get those up and running roughly somewhere close to what they've suggested, and if they can maintain margins on the excess capacity of, if the market will support, $7 margins for them, you're going to do very well buying. This is the fair value. You can buy a stock for fair value. You can count on all that further upside of future facilities, incremental expansions at their existing facilities, right? All of that they have called out and have potential to do. That's all just more upside to this, right? And of course, you're going to get the built-in growth just from, as time passes on, you're no longer discounting the future, because the future is, now, because it is 2027, 2028, whatever, right? And I have an alternative way to look at this. I guess I did on the second tab. So let me go through another scenario, which is they've already even said, hey, we're filing, or they did file with FERC for an expansion at the Plaquemines facility. And if I modeled that out in the second tab, where I said, in addition to CP2, what if they also expand the Plaquemines, which is a giant expansion? I think it's 18.6 MTPA is what it is. And so I think it's 13.3 nameplate with additional 5.3 of planned, excess capacity at that facility, or at that expansion. And so even that is just an additional, what's it, 20%, 15% larger of a company, and changing nothing, just assuming that they actually pull that off and get that going down. In the long term, they finally get to this free cash flow number of, about 5 billion. No, that's not right. I put in some additional, more bullish numbers here somewhere. Oh, I don't remember what I did. I'm sorry. I was playing around with all the numbers before we get on here. Maybe it is. Maybe that's the truth. Is that really all just from that expansion? It might be, because one of the other things that that I modeled here, that I'd have to compare it. And sorry, I've spent a lot of time on the spreadsheet, so I don't remember every single thing that I did. But one of the benefits that they get from these expansion projects is that the unit economics, from a capex and debt perspective, are better, because they're able to share a lot of the existing infrastructure. And they didn't give us exact numbers. I base this off of some of what we saw from other facilities, where they say, specifically Rio Grande and the plans for the Driftwood LNG facility, where we look at it and we say, hey, they gave this, I can't remember their exact metric, their dollars per MTPA, I think, is what they reported it as. But basically, you can look at it and they said, this is how much it costs us to build the initial facility and phase 1 per MTPA. But then the future expansions, right, future trains or the future phases at that existing facility that reuse that infrastructure, end up being significantly cheaper per MTPA, because there's already, infrastructure work that's been done, right? The site already has, is already established. There's already some infrastructure there in terms of, tanks and whatever else. I don't know enough about the industry to tell you in detail, but there's already some things that they can reuse there. And so just the project overall costs less. And so that is a benefit that they get. And so that, I think, might play into what my model is actually showing here. Excuse me. But they do get, under this model where they expand, do that Plaquemines expansion, which is significant, right? Like I said, it's 18.6 MTPA. That just by itself would get you to a current intrinsic value of about $12 per this model. I guess I'm wondering, I feel like maybe there is some other change in here, but I can't go through it now. I think all the assumptions in here are reasonable, right? That's a decent range for you to think about. And so this is why in my original, sort of my intro, I usually say, do I have a long position in this company or not? I do not currently hold any, because just I was not in a position to react quickly after the earnings, after the stock dropped. But, I think in the $8 to $9 range, I will be picking up some shares. If it's still trading in that range, $9 per share, let's say, in 2 weeks, when I get my when I get a little bit more cash coming in, you get a bonus that I should get in about 2 weeks. This is definitely near the top of my list to add to, right, in terms of stocks. And there's a lot of other stocks that have dropped recently, but this one, I think, does, I'd like to get some position in it, I think, at these prices. If it goes back up to 14, I'm less happy at that. I don't think I'd get in at that point. So that gives you the range, right? I think at 9, definitely at 8, I'd be buying a good chunk. I think I think it's, unless we see some massive negative impacts from the lawsuits, I think $8, I'll be buying at $8. Let me put it that way. I'm not recommending anything for anybody else. I'm not going to say that I think that's a good price, because, I don't really want to make those sorts of recommendations, but I personally will be buying, if it hits the, in the $8 range, let's say below $8.50, for sure. If that happens, when I get some cash in the bank, I'll be initiating at least some position here, because there is a good chunk of upside, right? There's a lot of risk here. I don't want to make it sound like there's no risk either. They've clearly done a fair bit. So I think, you have to trust the management team knows what they're doing, but there's also a limited history, right? They actually don't have commercial operations on anything yet. Technically, they're going to start that in April for the Calcasieu Pass. And they've talked a lot about this ability to have the excess production. And I was a little skeptical. Now that they've actually deployed the Plaquemines facility and tested it and said, hey, yeah, we've actually seen the individual trains produce 140%, of their nameplate capacity. And they spoke about this a little bit on the earnings call where they said, yeah, we were happy to see that happen, but it's what we expected because we took all the lessons that we learned from Calcasieu Pass and put in design improvements to the Plaquemines project, Plaquemines facility, and what we expected to be able to produce excess capacity is exactly what we saw. That gives me a little more confidence. I think that didn't really come through in their initial S1. They kind of said, we think we can produce way above the nameplate capacity, but they didn't give a whole lot of rationale as to why. Now that they've actually observed it, at least on a small sample, I'm willing to give them a little bit more, to believe it a little bit more, right? I still have some skepticism, and that's why I think in some of my model, I did not include this as a, hey, everything is able to do 40% over. I think in a lot of places I put in 25%. Some places I did use the 40% that the company provided. But anyways, hopefully that gives you an idea of how I'm looking at valuing the company. So I think, I personally, let me put it this way. In order to get to this $12 per share of intrinsic value, this valuation, you have to look out really far into the future, right? I'm looking out of them expanding their company and looking at cash flows all the way, where they don't actually finish the last facility until 2033, right? I'm building into this model that everything goes well for the Plaquemines expansion, and that happens all the way up through into 2030, 2032, 2033. Oh no, this is why it's so much larger. Sorry, I now I figured out why it was that much bigger. I also assumed expansion at CP2, where they have this stated expansion capacity they have at CP2. That's why this number is so much larger, and that's why the numbers change all the way out into 2033. That is, I just didn't name. I named it CP2 plus expansions, and I didn't tell myself which expansions I was talking about. But I modeled both of that again, the Plaquemines expansion and the CP2 expansion. So that explains why it's so much larger, because those expansions are able to be built at, again, lower unit economics, and also, those expansions, I assume they can get that 40% excess capacity that they're able to sell at, sort of higher profit margins. Anyways, so you could view it as $12 per share if you wanted to only give a 10% discount rate for all of those kind of unknowns and things that are pretty far out in the future. I think that's giving them credit. Usually I wouldn't do that so much, but maybe you want to do that. Maybe you think this is a fairly sure thing and you say, hey, $12 right now seems like a pretty decent estimate of intrinsic value per share. So, as time goes on, maybe maybe you'd want to continue buying because you do think that that's all going to happen sort of as planned. Again, I would personally lean more towards, I would want to buy closer to the 8, so somewhere in the 8s. I think in the 9s, I'll still want to get at least some position. In the 8s, I'd go heavier just because that's where I see it with, still giving them credit for a fair bit here, right? You still have to go out and include the CP2 facility all the way out in the future, discount this at only a 10% discount rate in order to get to that intrinsic value valuation. So that's kind of how I'm viewing it. I still think the $25 that they IPO'd at was significantly overvalued, but we'll see where it goes from here. All right, I've been talking for quite a while. I think that hopefully gives you a lot of detail into how I'm valuing the company. If you have any questions or comments, feel free to leave them on YouTube below the video. I do try to respond to all of those, or you can reach out to me on X. I have that, I'm just at Dustin Dollars. I don't see any other questions or comments in the chat. I'll give it just a minute in case anybody has any, since I went through a lot. But if not, I will go ahead and hop off shortly. For anybody who is watching, I will say I usually do streams. I try to do streams on a weekly basis on Sundays. I am definitely going to miss the next 2 Sundays because of personal reasons. I will be not available to stream. So hopefully 3 weeks from today, I'll be back and talking about something. I'm always happy to get topics. I know Transient Stacker brought up Archer Aviation last time. I started looking into that. I am not quite yet at the point where I could talk about it intelligently at all, because there's a lot to it, and I really don't know anything about the industry. But again, just giving it another moment in case anybody has any questions or comments they put in the chat. If not, I'm going to be leaving here very shortly. I hope anybody who did watch this, hope you got something useful out of the video. All right. I still don't see anything on the chat. Thank you all for watching. So I'm going to hop off and not waste any more time. Appreciate it. Have a good one.